Jana, small finance bank, shifting focus to that one. The Q2 net profit slumped 21% while NI saw a jump of 13%. We're joined by Ajay Kanwal, MD and CEO of Jana Small Finance Bank. Welcome to the show, Mr. Kanwal. Let's start off by the challenges in the asset quality. Talk to us about what's happening there.
So let me tell you briefly about the bank. Started 6.5 years back from a microfinance institution, which was our origin. We were an MFI since 2008. And one of the primary strategies we adopted was to convert to a secured bank. By secured, I mean assets like mortgages, LAP, gold loans, etc. And over the last 6.5 years, 65% of our asset book is now secured assets. So that's a very important thing to remember. Now, the balance 35% is microfinance, which is as of September. And clearly, as you may have heard in the industry, there is stress in the microfinance sector. Even though it's a small book for us now, we are not outside the industry. So we have seen some of that impact come to us. That has caused a elevated credit cost. And I must say, most of it was unanticipated. We could not see this coming in such a strong manner across the industry. And so obviously that has caused a rise in gross NPA. Given prudence and being conservative, we have provided, which is why net NPA is at 0.98 and PCR is at 67.5 or 67.6%. So we are well provided, we are well provisioned. And I must tell you that the way we see it, the peak of the credit cost is already past in Q2. It will get better in Q3 and further better in Q4.
So then let's try and understand this better. Is it a fair assumption or understanding for us that for now you do believe that the bottom is behind the bank and the second half of the financial year will only get better?
It is my belief that the stress in the MFI industry is man-made and not externally induced. So in the past, if you see, stress used to come from things like COVID, right, where we have no control, or it will come through some social event. There is no such reason in the last 6 months to say that is because of that. So the only thing I can think of is it is a case of over leverage of customers through variety of institutions. And I can see that if you look at all of the industry, we will see, of course, muted growth, which means people have become very careful. People have realized there's this path of growth where one doesn't follow disciplines the way they need to be followed, can lead to a problem for all. I think is obvious to everyone, which is why I feel Q3 will be better. I mean, you take our simplest example, our growth for unsecured book in the first half is -7%. So obviously, if I have degrown the book, I will have less problems anyway. Forget that the worst is already flown, because in unsecured, people, if you are defaulting, you kind of default and you actually go to NPA pretty quickly. It doesn't take long. In secured, the chance of you holding in bucket 1, 2, 3 or SMA 0, 1, 2 is higher. In unsecured, it becomes, if you're a low leverage customer, you can't pay, it goes on very fast. So I think the worst has flowed in. I think the bigger question that all of us should ask is, how will the industry dynamics shape profitability, ROAs look in the future? Because growing too fast is not correct. Giving too much leverage is not correct. So which means all of us have to work backwards and rework our models. At least if you are a large unsecured player. For us, long time back, we took the bitter pill and said, listen, the best way to build a good, resilient bank is to go towards secured assets. So we built it over the last 6.5 years.
Okay, so what does this do to loan growth for you?
Let's look at the basics, which means long term is intact. So asset of 20%, yes, it will happen. Growth of secured remaining at 67, 68%, that will happen. Growth of deposit business at 20%, that will happen. So three things will certainly happen, which means there is enough and more tailwind for the bank. Now what will happen is, yes, elevated credit costs will mean lower profitability for this year. How much lower? I think we'll have a good estimate in the third quarter. So yes, remaining at, we had given a PAT guidance of 30 to 40. I think now fighting for 30 is what we are doing. I think 40 may be a bit more challenging given the elevated credit cost. But having said that, like I said, for us, could we have hit our numbers of estimated PAT by growing unsecured book in the first half? Yes. But I think that would have been a very short-term decision. We decided not to grow because we wanted the environment to settle down to clear up. If it does mean a quarter of two of lower profits, I still think so that is a better decision for the bank, which we have taken.
So there's some bit of margin pressure, right? Is that deposit driven? Where is that really coming from, and what do we expect, or what should we expect going ahead?
The reason for the margin compression is a drop in unsecured book. It's a high yield business. High yield business has gone negative. Instead of growing 2%, it's gone -7. So obviously, and with some increase in delinquency, so interest in suspense also has caused the challenge. Yet we are at 7.7% NIM. We were at 8% in March. So it's not a huge drop. But yes, I think from 7.7, it should get better. Because as we keep stabilize unsecured, which means the growth rate will turn slightly positive, let's say in the second half. So obviously, NIMs will get better. Cost of deposit, I must tell you that we don't see it causing a challenge to us. And we don't see it growing from here. We actually see it slightly moderating downwards. And this is irrespective of any MPC decision, because we have actually cut our deposit rates from 1st of July. As you would read in the numbers, our deposit growth first half has grown 12%, 10%. Time deposit at 9, CASA at 12, total deposit at 10. So which is a very healthy clip. We are not very, we are working hard at it, but we certainly would add another 10% is the way we look at it. And we are not increasing the cost as we go into second half. So I think NIM will get slightly better. I'm very quiet about whether 7.7 will go back to 8 or not. Because see, like I said, one quarter safety will give us longer term safety. I rather go with that attitude. If I find the answer, I will go for it. But if I think that unsecured has to remain slow or just stable and not grow at all, and that is the right answer for the bank, then we would even do that.
Guidance metrics spelled out do you believe that's how it will shape up?
Yes, I think very close in every aspect, Parsh, and rightly calculated also. And I must tell you that if you pass with that result, then I would think that, we are in the business where you will have ups and downs. But I would take that as a good result for us if we do end up achieving that.
All right. Mr. Kanwal, thank you so much for taking the time out, and all the best